Welcome back, financial enthusiasts. Today, we're analyzing one of the most pressing financial issues of 2025, the recent stock market decline. With significant players like Tesla, Nvidia, and Palantir facing substantial losses, anxiety is palpable among investors. However, let's unpack whether this is the onset of a severe market collapse or merely a standard short-term correction. The previous trading week witnessed a startling downturn in the U.S. stock market, highlighted by a notable 1.7% plunge in the S&P 500 within a single day. Such a drop is alarming, yet experienced investors recognize that fluctuations and corrections are routine occurrences in the market landscape. Historically, the S&P 500 sees a 5% dip roughly 3 times a year, and a 10% drop at least once annually, which can adversely affect individual stocks, sometimes causing declines of 30–35%. Therefore, the current downturn may represent a typical market adjustment rather than the initiation of a protracted crash. A multitude of factors has contributed to this market lag, the foremost being the looming fear of a recession. Although the economic indicators appear robust, the market's forward-looking nature means investors are reacting to potential future scenarios. The prospect of a recession raises alarming possibilities. Dwindling corporate earnings leading to further stock devaluation, a decrease in consumer spending, and an overall decline in revenue for companies. Adding to the uncertainty, the Federal Reserve's postponement of interest rate cuts has left investors in a state of trepidation. With inflation sitting at 3%, above the desired 2%, the Fed's indecision regarding interest rates results in heightened market volatility. Higher borrowing costs deter both corporations and consumers, and as stock valuations fall, investors demand greater returns to compensate for risk. In conclusion, while the current stock market environment may seem ominous, historical trends suggest that such declines are part of normal market cycles. Smart investors should look beyond the immediate panic and evaluate the underlying fundamental factors. Navigating through market volatility requires a strategic mindset, and we will explore effective strategies to remain resilient in these turbulent times. Stay tuned, as understanding these complex dynamics will empower you to make informed decisions and potentially capitalize on the opportunities that arise from market fluctuations. The introduction of new tariffs championed by political leaders can shake the very foundations of economic stability. Proposed tariffs are expected to inflate the prices of imported goods, triggering a ripple effect across the consumer market. As prices climb, inflation follows closely behind, pressing consumers to tighten their purse strings. Household budgets that once allowed for discretionary spending now restrict possibilities, echoing a growing concern over diminished purchasing power. The consequences of heightened inflation are profound, particularly as businesses grapple with the decision of whether to absorb the costs or transfer them to the consumer. Rising prices lead to a scenario where the cost of living escalates, resulting in tighter monetary policy. Central banks, wary of inflation spiraling out of control, may delay necessary interest rate cuts, creating a paradox where attempts to stabilize the economy only prolong financial strain. This treacherous path may usher in stagflation, a troubling blend of high inflation coupled with sluggish economic growth that raises alarms for investors and policymakers alike. Consumer sentiment is equally impacted, as evidenced by the notable drop in the University of Michigan Consumer Sentiment Index to its lowest levels since 2023. In times of weakened confidence, spending on essential and big-ticket items drastically declines. The impact on corporate revenues becomes evident, leading to layoffs and an unsettling cycle of recession. When consumers brace for downturns, their instinct is to spend less, inadvertently manifesting the very recession they fear and setting off a chain reaction that reverberates through the economy. Despite the challenges posed by external factors such as tariffs and declining consumer confidence, historical insights provide valuable perspectives on market resilience. The cyclical nature of markets reveals that crashes, like the one in 2008, are often followed by substantial rebounds. Even during adverse economic conditions, the stock market has shown remarkable recovery, with the S&P 500 increasing by 700% over the last 15 years. Despite various crises, high interest rates, often perceived as a hindrance, have also failed to deter market growth, exemplified by the positive performance of the S&P 500 during 2023-2024. Furthermore, sectors like artificial intelligence are not mere speculative bubbles, but legitimate growth engines driving innovation and profitability across industries. Today's technology market is characterized by companies that are already generating significant cash flows and building practical applications. The current bullish phase harkens back to historical trends, suggesting that the present market could still be poised for additional growth. Recognizing these patterns helps inform expectations and decisions in the present economic landscape. In volatile markets, the instinct to react can lead to costly mistakes. Instead of succumbing to panic selling, investors should prioritize time-tested investment strategies that favor long-term success. History consistently demonstrates that the most profound losses arise from impulsive decisions made during market downturns rather than the downturns themselves. Taking, for instance, the infamous COVID-19 crash, the S&P 500 plummeted to 2,000 points, leaving many investors paralyzed with fear. Those who divested during this tumultuous period ultimately forfeited a remarkable opportunity to witness their investments triple in value within 5 short years. To capitalize on the low points of the market, seasoned investors often advise adopting the blood on the streets strategy. This method encourages individuals to seize the moment when prices dip by purchasing quality stocks that boast robust fundamentals. It's essential to overlook the discomfort that may accompany buying during downturns, for these moments often present the best opportunities for growth. Holding these investments for the long haul transforms temporary fluctuations into lasting gains, reinforcing the idea that patience pays off in the world of investing. Another effective strategy is dollar cost averaging, DCA, which involves consistently investing a predetermined amount regardless of market conditions. This approach eliminates the temptation to time the market, thereby easing the anxiety linked to price variations. As a result, investors can enjoy the benefits of long-term compounding while steadily building their portfolios. It empowers investors to focus on consistent growth rather than short-lived market trends. Ultimately, maintaining a long-term perspective is vital for successful investing. Long-term investors have the advantage of buying into the market during downturns and holding for years, allowing compound returns to enhance their financial growth. Ignoring sensationalized media narratives and fleeting panic headlines enables investors to uphold their strategies and remain focused on broader market indices, like the S&P 500 and select high-quality stocks. The essence of wealth building lies not only in strategic entry points, but also in holding investments for an extended period, 10, 20 years or more. In conclusion, enduring market downturns proves to be less catastrophic when viewed through the lens of long-term growth. Fear-driven selling only serves to magnify missed opportunities, while opportunistic buying during these challenging periods can lead to impressive investments. By embracing calm, discipline, and a forward-thinking mindset, investors can confidently navigate through market fluctuations, fostering enduring financial success and wealth accumulation.